Okay, mic चालू करूँ. Yeah, so good morning everyone. Hope I'm audible clearly.
Yes, sir.
Okay, so we'll wait for another 2 minutes and then I'll start. Okay, so today we start with the projection and forecasting technique. So see what happened whenever we are preparing any plan. Okay, we need to project on some like project the situation. Okay, on the basis of some assumption. Okay, say for I'm planning to sell 1 million. Okay, so then I need to calculate my all the other line item, maybe the expenses. Okay, which will give me the idea about the profit. Okay, if I plan to sell 2 million, the same thing. Okay, so I mean, at what level I am able to generate what profit, that we need to understand. Okay, so beside the profit, what other things you need to plan while giving the projection to management? Anyone has any idea or any clue? Like if your management asks, like we need to plan for 2026 now. Okay, so of course any planning start with the sales target. Okay, but what other plans you can do along with profitability? I mean, profit we just spoke. Okay, so what other factors you need to evaluate? Means what you are going to forecast. Okay, so for achieving this 1 million sale or achieving this 2 million sale, okay, so what we need, I mean, is it possible for is it possible for me like I mean just because I'm getting a projection from the sales department, okay, we are okay to do the sale of 1 million or 2 million. Okay, so just because they said whether I'm able to execute this sales, what other factors we need to plan? Working capital, because we need to give
There
the
is
credit to,
with budget
sorry, yeah, budget, but for what?
that how much budget we needed to achieve our target.
Yeah, but budget for what purpose? Like working capital budget, I can say. Okay. Beside that, inventory turnover, then payable deferrals. Okay. Capex investment. If I don't have a capacity, even though I have an inquiry for from the market, but if I don't have a capacity, okay, then either we need to go for a investment or we need to outsource some of the activities. Okay, so capex investment. So for doing a capex investment, automatically you need to see how you are able to get the finance. Okay, so either equity is both common stock, preference stock, or the loan. Okay, so these are the factors you need to evaluate, and last it is end with the cash flow. So forecasting generally we are doing, or the projections we are generally doing to understand what could be my limiting factor to achieve my budget or to achieve my target. Okay, so it is not like this, I just need to focus on a sale. Okay, so automatically profit will come, automatically we are able to get for the amount for the investment. Okay, automatically we are able to manage the creditors payable. Okay, so that is not going to be happen. Okay, you need to first list out, means on a particular sales level what would be the, I mean how it is impacted to the other factors. Okay, so that is basically the this is basically the forecasting. Okay, we need to project first sales and then we need to forecast all other activities. Okay, so it is mainly sensitivity analysis. Why we called it as a sensitivity analysis? Because like we are projecting at a certain level how the other factors behave. Okay, so like if I decide to achieve the 1 million sales, then my working capital or the capex investment may be not required. But if I decide to do the 2 million sale, then and I have a capacity up to 1.5 million sales. So there is a question of capex investment arises. Okay, so that is basically the sensitivity analysis. Okay, what if analysis, I mean because of one factor how the other factors behaving. Okay, I start with the sales and then we need to evaluate what would be the impact of this sale on my working capital, on my capex investment, on my cash flow. So we can see here July sales for Beezer company are projected to be 100,000. 100,000. Okay, with the cost of goods sold of 60,000 and general administrative expenses at 25,000. The CFO has determined that variability in sales has the biggest impact on profitability, and she want to determine the effect of operating income if sales dollar are over or underestimated by the 25%. Okay, so basic, I'll write in Excel, 100,000. 100,000. Okay, here I am considering 75% and I am considering 125%. Okay, so that is my sales at different level. Okay, it is projections. Okay, now how it affect to my profitability, that I want to see. So variable cost is always the percentage in terms of sales is static. Okay, the absolute amount may be different. So here it is given 60,000 against 1 lakh of the 100,000 of the sale. Okay, 60,000 against 100,000 of the sale. So I assume the variable cost is 60%. Okay, so I need to consider the 60% of the sale. This is my contribution margin. Fixed cost, mostly non-controllable cost. So it is irrespective of the sales, it is same, which is 25,000. Okay, so my profit is like this. Okay, so at various level means this is basically my regular level, then it is how I can say, like at a highest level, and this is one of the lowest level, and then we need to determine what would be the profit impact. So still at the lowest level I am able to absorb my entire fixed cost. So it is okay for me, better condition. Okay, so now we need to see. Yeah, so 5,000, 15,000, and 25,000. Because the cost of goods sold remain a fixed percentage of sale and the general administrative remain constant, therefore the independent of the sales. So the biggest impact on operating income will result from sales being different from the estimate. Okay, so this is basically the fix, okay, but this are the this is basically the my variable factor, okay. So whatever may be the profit impact, that is mainly because of the sales to variable cost ratio, okay. So that we need to know. So basic intention is basically at what sales turnover level, what profit you are going to achieve, okay. Also keep in mind here, like investment is more or less same in all scenario. Okay, say for 5 lakh is my investment. Okay, so if you compare the profit with respect to investment, so that get changed on all the level of the sale. Okay, so your because of your lower sales, your rate of return on your investment goes down. Okay, so this factor we are analyze keeps on analyzing, and we need to evaluate what would be the impact on our achievement. Okay, so that is basically the benefit of the forecast. Then scenario analysis. This is basically the sensitivity analysis. Okay, so it is like pessimistic, optimistic, or over optimistic. It is like this. Okay. Now, if the situation change in preparing the model for future period, manager may prepare multiple different scenario which represent alternative possible outcome. So budget will be prepared under each scenario and the probability may be assigned in order to come up with the weighted total. Okay. So optimistic scenario, 30% likelihood, the 5% sales growth. Pessimistic scenario, 20% likelihood, so 5% sales decline, and most likely scenario, 50%, so no sales. Okay. So expected growth rate is basically like 30% chances for the 5% growth. It is probability. And this is my growth rate. Right. Okay. Then 50% chances, sorry, 20% chances. This is minus 5%. Okay. And the 50% chances as it is, no growth. Okay. So when we multiply this with this with this, okay, then you come to know the total growth is basically when 30% multiplied by 5% plus 30%, sorry, 20% multiplied by minus 5%. Okay, and the plus 50% multiplied by 0. Okay, so this is basically the 0 and the answer is 0.5% growth. Okay, so whatever may be the sales turnover we achieved in the last year, we just need to increase the growth by 5%. Okay, so 40 million, 1.00, 40.2 million is projection sales for the next year. Okay, so you may get this way also. Okay, so 20,000 cells, the probabilities are 20%. 40,000 cells, the probability is 30%. 50,000 cells, the probability is again 20%. And 100,000 cells, okay, the probability is 20%. So on that basis, my estimated sales is okay, so this basically the 4,000, 12,000, 10,000 and 20,000. So if you total 30, 42, 46,000. So I can project with this. I mean, this I will consider as my sales target for next year. Okay. Here we calculated the growth, and here we calculate the sales in absolute number by applying the probability for a particular level. Okay. So I'll consider for next year's sales target is 46,000, and then I start for the other planning for the other factors. Regression analysis. So regression analysis is basically y equals to a plus bx. Okay, so x is basically the independent factor, or given number, and the y is basically the dependent factor. Means you can calculate with reference to x factor. Okay, with reference to x. Okay, so generally, if you see y equals to a plus bx, I mean, see here they mentioned the alpha and beta. I consider the a and b. Okay, so this is my graph. Okay, so what happened if I want to see, this is basically the y-axis and this is x-axis. Okay, so on each level, okay, what is the impact on a y? Okay, as there is a fixed cost, like a is basically the fixed cost, so I need to start somewhere from here, because if the volume is zero, even though I need to incur this cost. Okay, so that's why I need to start from this level. Okay, and then as the volume increases, my cost get increases like this. This is my total cost. Okay, so generally if you see this equation, a denote the fixed cost. Okay, B is giving the variable cost ratio. Okay, X is basically the quantity. Okay, so Y is basically the, I will get the total, no, yeah, total cost. Not total cost, basically, it is basically the profit, I can say. No, yeah, total cost. Okay, so if your volume is zero, still you need to incur some fixed cost. So when your volume is zero, your total cost is equals to A. Okay, means whatever may be the fixed cost. Once you start to increase the volume, there is a certain variable cost component added. So that's why it started to grow like this. Okay, so that is regression analysis. So on the basis of fixed cost, variable cost ratio, and the output activity, you can calculate what is your total cost. So here if you see, the dependent variable, the variable we are trying to explain, for example, y might be the total cost measured in dollar for a cost function, and the dependent x is the dependent independent variable, means for what number we are calculating the total cost. So variable that explain y, for example, in cost function, x would be the total activity or output. The y axis intercept of the regression line. For example, if y is the total cost, a would be measure the total fixed cost, and b the slope of regression line. For example, if y is the total cost and x is the output, b measure the changes in total cost due to the 1 unit change in output of the variable cost per unit. Okay, so like means whenever you want to calculate the total cost, you need to have a regression equation which gives a is the fixed cost, b is the variable cost ratio multiplied by x, which is basically the number of output produced. So at any level of production, you can, if you have this equation, then any level of production you can calculate the total cost. Okay, now how we are preparing this equation, this is depend on our experiences of last year trend. Okay, so we will see there are various methods which help us to calculate this equation. Okay, so that is basically the regression equation. Always keep in mind, total cost never be a zero, because the fixed cost, whatever you need to incur, that is a part of the total cost. So total cost never be a zero. Variable cost could be the zero, fixed cost as it is, you cannot reduce it. Okay, so this way you need to calculate the total cost. So application, if Y is the total cost and X is the total activity or output, our goal of regression analysis would be predict total cost. So Y is the dependent variable based on the observed total activity or outputs. Okay. So you need to calculate. I mean, in exam you may get the question on calculation of the total cost. Okay. Then coefficient of correlation. Okay, so the coefficient of correlation measures the strength of the linear relationship between the independent variable and the dependent variable in standard notation. So the coefficient of correlation is R. So it is basically, see, you are calculating the total cost. Okay, so if your quantity increase from 0 to 1000, your total cost supposed to be increase. Okay, that means if the quantity increases, cost increases. This is basically the positive correlation or the direct correlation. Okay, is there any chance when your quantity get increase, okay, your cost get decrease? Total cost, we are talking about the total cost.
We can control soon, but it
Cannot be
it
decreased.
might not.
Cannot
No,
be
no.
decreased.
We can, yeah, cannot.
Okay, I tell you something. If you are producing 10 quantity, okay, at that time your variable cost ratio is a 70%. Okay, you can take an example. Okay, for 100, 70 is your cost and your fixed cost is 20. Okay, the profit margin is 10. Okay, and the total cost is basically the 90. But when you are producing the 20 quantity, okay, you may get the additional 40% discount. Okay, so automatically your variable cost is 30%. Okay, so if you see this, okay, so for 20 quantity means 200, okay, and then 30% is basically 260, and you can consider the 20. So here also, okay, you can consider here 20%, so it is 40. So your total cost is basically the 60. So for increase in volume, okay, so your for increase in increasing volume level, your total cost goes down. Means at 100 you need to absorb the 90, but at 200 you need to absorb the cost of 60. And this happened in a practical situation as well. Particularly when some like supplier floated a scheme, very attractive scheme, and in that situation, if you compare your total cost with respect to the future past trend, okay, you will find a huge saving. So that happened. Okay, so whenever my turnover get increased, in relation to the turnover, my cost goes down. Okay, so that happened. It is not like this. That is not going to be happen. Sometime it happens. Okay, the chances are rare, but it happened. Okay, so that is basically the inverse correlation. Okay, and if even though there is an increase in volume, your cost is fixed. It happened when particularly if you see the service industry where you need to hire, there is no variable cost. Okay, only there is a fixed cost. So irrespective of the volume, the cost is same. Okay, so cost is same. So it is basically the no correlation. your total cost is same irrespective of the value. Okay, so all three scenario you can see in a practical situation as well. Okay, so positive correlation means your total cost get increased along with the increase in volume. Negative correlation, sometime occasionally your total cost goes down along with the increase in volume, and the no correlation, total cost as it is even though there is an increase in volume. So this happened in case of a mostly in a service industry, because in service industry only people are working, and this is basically, and all the employees are getting a fixed salary. Okay, so in that situation there is no variable cost. Okay, and that's why irrespective of the volume you are irrespective of the volume your cost is same. Okay, so that is basically the no correlation. So you can project the cost on the basis of input, but to what extent it will give the, how I can say, I mean, like a coefficient of correlation. So it is basically, how I can say, what is the factor you are going, or at what level you are saying, okay, this is going to be happened or this is not going to be happened. Okay, so generally it is correlation coefficient, it is generally between the 0 to 1. Okay, so as more unit of a given product are produced, a reasonable expectation is that total cost will increase. That is basically the most reasonable expectation, but that can be like depend on the situation. So if it is the coefficient of correlation is negative, then what would be the situation? Like your total cost may goes down. Okay. Then the coefficient of determination. So determination is basically at particular, means there is a certain deviation. So say for at 10 quantity, my total cost is 20. At 20 quantity, my total cost is 18. So there is a deviation. So when you represent this deviation in a square form, square form. Okay, so it always give you the in a positive number. Okay, for the additional 10 quantity, the cost is -2. So if I square it, it become the 4 like this. Okay, so always give in a positive number. Okay, so coefficient of determination is the proportion of total variation in the dependent variable explained by the independent. Like this is my, say for, this is my dependent, independent, and this is my dependent. Because of change in independent variable, there is a change in dependent variable, and if I measure this, okay, and that I need to measure in a square form, so all number I will get in a positive. Okay, and this will give me a confidence level, means at, if the higher is the number, like 80% is the number, okay, so then at 80% I am going to achieve 80, with the 80% confidence I am going to achieve this deviation. That is basically the meaning. Okay, so interpretation, the higher the r square, the greater the proportion of the total variation in y that is explained by the variation in x. So that is the higher the r square, the better the fit of the regression line, means this is more correct regression line. Okay, so I'll tell you something. So it is not always straight. Sometimes it is like this. If this is this, then it is a straight. But if like this, okay, then we need to calculate the coefficient of determination. So in exam, you do not have a required to calculate the coefficient of determination. Okay, and like if the higher is the coefficient of determination, that means whatever may be the regression like we consider, or whatever may be the regression equation we consider, this is right. Okay, so coefficient of determination, generally I'll take a 5 sample, 10 quantity, 20 quantity, 30, 40, 50. Okay, my total cost is basically on 10, it is 12, in 20 it is 15, 40 is basically 25, and the 50 is basically again 20, like this. So for 10 quantity, the variation is 3. Additional 10 quantity, the variation is 5. Then additional 10 quantity, again 5. And then additional 10 quantity, you can say minus 5. So then we will take a square, 9, 25, 25, minus 25. So almost it is 34. Okay. So this will be the 0.34 would be my percentage level. So this way it is, if it is higher, means if it is lower, then I can say, as it is a lower 34%, then I can say the regression line may not give a correct result. There may be a certain other factors which impacted. Okay. It is not only impacted by the X or whatever the dependent variable factor. Okay. But if this is somewhere coming around 80%, okay, so then I can say, okay, mainly the cost changes due to the due to the independent factor or due to the X. Okay. So that is basically the interpretation. So you can see the example here. So based on looking at 5 years of data on a fixed cost and variable cost per unit, Rexon Inc. determined that the fixed and variable cost in the next year will be 16,000 and 4.5 per unit respectively. So Rexon has determined that the correlation coefficient between the independent and dependent is equal to 90%. So it is basically more or less okay. The R square for the regression equation 16,000 plus 4.5x with x being the volume is equal to 0.81, and R square of 81% means that 81% of the changes in total cost during a period can be attributed to the change in volume. Means, see here it is 34%. That means my total cost is affected by some other factor. It is not because of X. Okay. But if it is 80% or 90%, that means the my total cost affected by the given independent variable, like this. That is basically the interpretation. So this
So,
is,
sir, in exam, we have to just derive the equation.
no, it
There
is
will
not.
be no such analysis.
You do not require to do any analysis, okay, in examination. Here just they may float a concept, means if this is the situation, what you are going to react on it, means whether you need to see the coefficient of determination or what. Means you just need to keep in mind the logic that if the coefficient of determination is less than somewhere 80%, okay, so then that means the total cost is not driven by the X factor, okay, it is always driven by some other factor, okay. And if it is more than 80%, means 80% confidence level is sufficient, so it is mostly driven by the X factor. That only line you need to keep in mind for the coefficient of determination. You will not get to calculate all this thing.
So, can you just repeat difference between correlation and determination?
Coefficient of correlation is basically justifying how, like coefficient of determination giving a clue whether, like whatever the dependent factor, independent factor you considered for calculating the total cost is really driving the cost. Okay, that is coefficient of determination. And coefficient of correlation is basically because of, like it is because of X factor, what is the impact on Y factor. Okay, so that is the, like, here you are not testing whether the independent factor is correct or not. Here what happened, you are testing what is the relation between independent factor like X on dependent factor. Okay, we assume like cost is driven by X only. Okay, this is clear. We are not going to test whether it is driven by X or not. It is driven by X. Okay, but what is the correlation? Because of change in X factor, what is the impact on Y factor? That we are seeing in a coefficient of correlation. And coefficient of determination, okay, here we are testing whether X factor impact the Y factor. Like as I said, in service industry, like we spend some hours for a particular client assignment. Means as a CPA, if you are calculating the tax work for a particular client, okay. So you are maintaining the hours on a per client basis, but really that derive your total cost? No, because you need to hire a people, whether you have a work or not, you need to maintain a fixed cost. Okay, so R cannot be the driving factor for the cost in a service industry. But when you are selling a material and you are you need to buy the raw material from the supplier, okay, so that could be the ratio, or that could be the driving factor for your total cost. Because if you want to produce 10 quantity, then you need to buy the 5 quantity of the input. But if you want to produce the 20 quantity, and then you need to buy the 10 quantity of the input, okay, which will ultimately increase your cost. Okay, so that is basically the situation. In coefficient of correlation, we are comparing the impact of X on Y. Okay, in coefficient of determination, we are finding whether X is the factor which impacted to the Y. Clear difference?
Yes, sir.
Okay. And this two line only you need to keep in mind. Means, in examination, you will get the question on those logics only. Then high-low method. In high-low method, actually, means I know the say for 5,000 quantity, my total cost is 10,000. In 7,000 quantity, my total cost is 12,000. Okay. In 10,000 quantity, my total cost may be the 15,000. Okay. So this is my total cost, means variable cost plus fixed cost. Okay. So I want to project what would be my total cost at 8,000 quantity. Okay. So for that I need to use the high-low method. Okay. So this is basically the highest number, and this is the lowest one. So I ignore this one. Okay. So here if you see from 5,000 to 10,000, the quantity increases 5,000 and the cost increases also 5,000. Okay. So this, if you consider, so per quantity is basically 1. So that is my variable cost. Okay. So whatever may be, so at 8,000, okay. So per quantity is 1. Okay. So for 10,000 quantity, if I need to incur a 15,000 total cost. Okay. So that means like 10,000 is my fixed cost. Okay. 10,000 plus 5,000, total cost is 15,000. At 5,000 quantity, the same equation, 10,000 is my fixed cost. Yes. Student for additional 5,000. Sorry, incremental cost is 5,000. So 5,000 is basically the fixed cost. Fixed cost. And like, yeah, 5,000 is my fixed cost and 1 rupee is my variable cost. Okay, not 10,000. Okay. So if the for 10,000 quantity, variable cost is 10,000 and the fixed cost is 5,000. So this will get match. Okay. And the 5,000 quantity, variable cost is 5,000 and the fixed cost is again 5,000. Okay. So this way we are going to match 10,000 and 15,000 and 10,000. Okay. I'll explain this again. Quantity and the total cost. Okay, 5,000 quantity, my total cost is 5,710. 5,000. 7,000 quantity, my total cost, sorry, it is 10,000, 12,000, and the 10,000 quantity, my total cost is 15,000. Okay, so what I'm going to do here, like for additional delta quantity, what is my delta cost? Okay, so it is 5,000 delta quantity and the 5,000 is my delta cost. So per unit variable cost is 5,000 divided by 5,000. So it is delta cost divided by delta quantity, which is 1. If I consider this, means my like for 5,000 quantity, okay, if I consider this, the total cost is, okay, minus variable cost, okay, which will give me the fixed cost. Okay, so total cost at 5,000 quantity level, 10,000. Per unit variable cost is 1, so it is 5,000. So my fixed cost is 5,000. Okay, if I apply this equation for 15,000 quantity, so if you see it is correct, sorry, 10,000 quantity. So my variable cost at 1 rupee, it is 10,000, and my fixed cost, we just calculated. Fixed cost, we just calculated 5,000. So it is get correct, 15,000. So on that basis, I can project my total cost at 8,000 level, which is basically the variable cost 8,000 at 1 rupee plus 5,000 fixed cost. So it is 13,000 is my cost. 13,000 is my total cost. So that is high and low method. Okay, we can see here. So gather data, compare the high and low volume and cost, ignoring the obvious aberrations. So outliers which are unusually high or low volume are eliminated. That we should not consider. Okay. So analyze the data, divide the difference between the high and low dollar total cost by the difference in the high and lower volume to obtain the variable cost per unit. So what we did here, we are calculating on that basis delta quantity, delta cost, variable cost per unit. Okay, subtract the total calculated variable cost from total cost to obtain the fixed cost. So here total cost is 10,000 minus 5,000. So 5,000 is my fixed cost. Okay, and then we need to create. So formula result, the result enable preparation of the flexible performance budget by identifying the total fixed cost and variable cost per unit. This may be used to estimate the total cost at any volume. So on that basis, I am able to calculate the total cost, okay, at 8,000 volume. Okay, so that is basically, okay, this is example. Okay, so that we are using this formula, we are using to flexible budget. Okay, so flexible budget is a series of budget that are prepared for a range of activity level rather than the single activity level. Okay, so master budget are generally the fixed in nature. Okay, master budget, we generally calculate the most desirable volume. Okay, say for 100,000. Okay, but what happened? We need to evaluate some alternate scenario, say for 25% down or the 25% up. Okay, so whatever may be the situation at 100,000, we need to evaluate what would be the situation for 75,000 and what would be the situation for the 1,25,000. Okay, so this is basically the flexible budget. Okay, so when we prepare the budget at 75,000 level with respect to assumption what we consider for 100,000, and the same when we prepare the budget for 125,000, okay, with respect to assumption considering 100,000, that is basically the flexible budget. So this is simple. Means if you see the total cost equals to fixed cost plus variable cost per unit multiplied by number of units. So that we already saw. We need to take this example basically. Okay. So here if you see the volume given January, February, March, April, May, June. Okay. So 6 month volume, which is 1200, 1000, 1050, 1130, 1400 and 1200. Okay. So highest is in between 1200 twice. 1000 is the lowest one and the highest one is 1400. So May and the February. Okay. So I'll consider Feb volume and the May volume. So Feb quantity is basically 1000, lowest one, and the May the quantity is basically the 1400, highest one. This is quantity. This is total cost. Okay. So total cost at 1000 is 8400, 450, sorry, and 1900, 550. Okay. So for 400, my incremental cost is 9550 minus 84 minus 8450. So it is roughly 1100. Okay. So variable cost per unit is basically 1100 divided by 400. Additional cost divided by additional quantity. That is my variable. So 2.75 is my variable cost. So what is my fixed cost? If I consider 1000 at volume, so variable cost for 1000 quantity 2.75 multiplied by 1000. That is my total variable cost, and the total total cost is 8450 minus 2750. Okay, which is 5000. This is my fixed cost. Okay, how I derived this number? Okay, so my total cost at 1000 level is 8450 minus what is my variable cost, which is 2750, which will give me the 5700. This is my fixed cost. Okay, so using either the high or low produce the same total fixed cost result 5700. Okay, so if I want to test, means because they gave a various volume, okay, but it is not given the 1500. So what would be my total cost at 1500 level? So it is quantity 1500, total cost is variable cost plus fixed cost. Fixed cost is given 5700 and variable cost is 2750 multiplied by 1500. So it is 4125 plus 5750, 5700. So total cost is it is 9825. Okay, so you may get this question for calculation in an examination. So this way you need to calculate. So total cost at 1500 quantity, it is 908.25. Clear? Learning curve. Any doubt here?
No, sir.
Okay. So learning curve is basically means while doing a repetitive work, okay, your speed get increased because of training, because of experiences like this. Okay. So for calculating for manufacturing one quantity, you may need 2 hour time. Okay. But for two quantity, if the 90% learning curve or 90% hours is required. So for two quantity, you need 1.8 hour. Sorry, 4 multiplied by 90%, 0.4, sorry, 3.6 R, 3.6 R. Okay, so that is basically that means 90% is my learning curve. Okay, for 4 quantity, not 3 quantity, it always double. Okay, so like 3.6 multiplied by 2 multiplied by 90%. So it is 6.48. Okay, for 4 quantity you need that much amount, like this. Okay, so this is basically the learning curve. Means as your output increases, the time you need to spend per unit get decreases. Means if you see here, like this divided by 4, so it is 1.62 here, 3.6 divided by 2, so it is 1.8, and here basically the 2 hours. So per unit, for production of first unit, it is 2 hours required. For 2 quantity per unit is 1.8. For 4 quantity per unit is 1.62. So that is basically the benefit of learning curve. Means your per unit time get reduced. So that is learning curve. If you see this example, it takes the John's production company 50 hours to produce the first unit of its only product. Required, assuming a 70% learning curve, estimate the average time and the total produce 2, 4 and 8 units. So it is always in a multiple, means 2, 4, 8, 6, 8, then 64, like this. Okay, so if you see for first product, it is 50 hours. Then 2 product, it is 70%. So multiplied by 0.7. So 35 unit per hour. Okay, and the 4 is basically multiplied by 0.7. 24.5. So 2 is basically 35, 50 hour, 30 for 2 quantity, 35 unit, 35 hour per quantity. For 4 quantity, it is 24.5 hour, like this. So it is, yeah, 35 hours. For 2 units, it is 70 hours. Okay, and the 4 unit, it is 24.5 hours, or 24 multiplied by, so it is 90 hours. So 8 unit, it is again 24.70, 17.5. So 137.2. So it is always get double. 64, like this. It is always get double, and then 70% we need to cut down, like 24 point multiplied by 0.7. 17.5.
So it will be cumulative, sir.
And then you need to multiply. Yeah, it is not cumulative, it is per unit. This is total. So it is 274. Sorry, 4 after that, here 8 required. So 137.2, this way. That is basically the benefit of, means how we are calculating or estimate the time required for a increased production. Okay, so this in practical sense, it is not like this. Means if you go for a 32, 64, it is not like this. At a various level, this going to be stand. Okay, because I mean, even though you increase the efficiency, but some minimum time required at any situation. Okay, so but for doubling the turnover or 4 times the turnover, we can use this formula. So this is learning curve. Okay, so where, means if it is given the 90%, then you need to multiply with the I mean whatever may be the original number multiplied by 90%. Okay, and always you need to make a quantity double. It is not like this, that 4 and then 5. It is 4, 8, 16, 32, like this. Okay. Then cost volume profit analysis. Okay. So all costs can be separated into either variable and means whenever you are doing the cost volume profit analysis, okay. So you need to first bifurcate what are your variable cost or fixed cost. Volume is the only relevant factor affecting the cost. I mean, this is basically the assumption. It is not necessary. Volume is the only factor affecting the cost. Okay. All costs behave in a linear fashion in relation to produce the volume. That is also not necessary, but we need to assume. Cost behavior are anticipated to remain constant over the relevant range of production. That we are talking about the fixed cost. Okay. So what happened? Like whatever may be the cost behavior, like I suppose means I supposed to bifurcate variable and the fixed cost clearly. There is no question of semi-variable cost. Otherwise, we cannot do. Okay. So fixed costs should be constant for a given range. Okay. If it started to increase or if they have some component of the variability, then you cannot calculate properly. Okay. Cost show greater variability over time. The longer the time period, the greater the percentage of the variable fixed cost. Okay. So, means like I'll tell you something. If a particular project it requires a 10-month time, okay, and if a particular project it required a 1 month time, where you can predict a cost properly. Any guess? Or instead of 10 month, it is 10 year. In 10-year time, what happened? Other fixed cost also get increased drastically. It is no more fixed. Okay. Say for maybe the land, maybe the static or the building may get depreciated, but the property tax, okay, that may get increased on year-to-year basis. So in long run, all costs are the variable cost, okay, and salary increase, supervisor salary increase. So supervisor salary increase, okay, so that is also the increases over a period of time. So in long run, all the costs are the variable cost. If the period is shorter, okay, then they can behave in a fixed way. So the product mix remains constant. Contribution approach is used rather than absorption approach, and the selling prices remain unchanged. Okay. So mostly, if all the factors are in control situation, then you can calculate the cost volume profit analysis. Okay. So okay. So like selling price remain constant, variable variable cost is also constant. Okay, so your contribution margin is more or less constant, and then whatever may be the fixed cost, as we already discussed, there is no portion of semi variable cost. So then you can means evaluate what would be your cost, what would be at particular volume, and what would be your profit. What would be your profit. Okay, so this is with respect to all these assumptions. Okay, so again, all costs can be separated into either variable or fixed costs. So whenever you are doing cost volume profit analysis, you cannot consider the semi variable cost. Volume is only relevant factor affecting the cost, means but it should not be the case the other factor also affecting the cost. As we saw, when we calculate the coefficient of determination, it looks like that the coefficient of determination is less than 50%. So if it is less than 50%, that means the volume is not the only factor which driving the cost. There are certain other factors which drive the cost. Okay, so that should not be the case. all costs behave in a linear fashion in relation to the production volume. So if it is linear, that means contribution margin ratio is constant for all at all production level. Cost behavior are anticipated to remain constant over the relevant range of production. What does it mean? Like your fixed cost is always a fix. Okay, means in a within a given production level, your fixed cost should be the same. Okay, cost show greater variability over time. Okay, so that you need to understand. Okay, all fixed costs are variable in long run. Okay, so if your time period for completion of the project is high, that means you need to consider all cost as a variable cost. Okay, because even though the depreciation of building is not get increased, but the property taxes and the other fixed cost is get increased over the period. So cost shows the greater variability over the time. Okay, and the product mix remains the constant. So contribution approach, direct costing is used to use rather than the absorption approach. So what is the contribution approach and absorption approach? We will see it, and the selling prices remain unchanged. Those selling prices should not be changed. Okay, then and only then we can calculate the cost volume profit analysis. Okay, see, as I say, the contribution margin should be your static. Okay, that means whatever may be the changes in sell price that reflected in increasing in the cost as well. So the absorption approach, which requires the financial reporting under US GAAP. In US GAAP, we generally consider the absorption approach. So what is difference in absorption approach? I tell you. In contribution, what happened? We calculate the contribution margin and then deduct all fixed costs. Okay, whether it is related to the production or admin. Okay, contribution margin we calculate and then deduct all fixed cost. Okay, in absorption we calculate the gross profit. That means production fixed overhead we considered and then we deduct admin cost. Okay, so as per US GAAP we need to follow the absorption system. Okay, why there is a I mean in this two methods, because we are calculating the profit only after absorption of all the fixed costs in both the places. The only thing is that we first calculate the contribution margin and then fixed cost. Okay, and here we are calculate the gross profit first, and which consider the production overhead, and then we need to deduct the fixed cost. Okay, so what could be the difference? Any guess? When you calculate, I mean, in contribution approach, all the fixed cost you consider as a period cost. All fixed cost, whether it is a production or admin. Okay, so there is no postponement or the carry forward of the production overhead. Okay, no postponement or carry forward. Okay, so that happened in the contribution margin. Okay, in gross profit, what happened? We charge the production overhead and sometimes we transfer it to WIP. So all fixed costs not debit to P&L account. Okay, and this is, so there is a change in treatment only for the production overhead in both the approaches. All fixed costs do not debit to the P&L. Okay, some of the fixed costs carry forward, production overhead, carry forward, or postponement.
So what about the depreciation and all other expenses?
Yeah, so if the depreciation is related to the machine, okay, then it is a part of the product cost, okay, and if it is increase in WIP or FG, okay, then automatically all depreciation expenses not charged to P&L, because some of the expenses charged to WIP oblique FG, okay, because they consider it as a product cost, okay. Keep in mind how actually happened in practical scenario. Depreciation first charged to like cost center, production cost center, okay, say for assembly department, okay. So it is not directly charged to P&L, it is charged to assembly department, and whatever may be the cost incurred in an assembly department, that we recover on a cost of goods sold or the product, okay. So say for, I mean, there is, this is your first year of operation, okay, and current year you produce 1000 quantity. For that, the depreciation cost is 1000. Okay, so it is loaded on a inventory. It will not directly loaded on a cost of goods sold or the P&L. Okay, so inventory value increases by 1000. Okay, out of that, out of this 1000 quantity, if you sell 700, okay, and 300 is in inventory, okay, so only cost related to the 700 quantity get debited as a cost of goods sold. COGS. Okay. So entire 1000 depreciation expenses not charged to P&L. We are talking about absorption costing. Okay. Charged to P&L. It is only 700 charged to P&L. P&L, and the remaining 300 is basically in the inventory. Okay, so that happens in an operating cost, absorption costing, which is accepted in a as per the US GAAP. In contribution margin, approach, so it is sales value minus variable cost. Okay, this will give you the contribution margin, and then all fixed cost, including the production overhead, that is considered as a all fixed costs considered as period cost. Okay, so fixed cost, okay, both admin as well as production overhead, and then you will get the net income or the operating income, I can say operating income. Okay, so here what happened, inventory valuation we do with reference to variable cost only. Okay, in absorption costing, we do the inventory valuation by considering variable cost plus fixed production overhead. Okay, so because of that reason, if I consider the, I mean, now you are able to understand the difference between absorption costing and variable cost, contribution margin costing. Only the fixed working FG or the work in progress valuation get changed, and because of that reason impacted the profitability. Okay, so if my change in inventory means, you will get the question like this: change in inventory. Okay, means this is FG plus WIP. okay, is positive. Okay, so what is the impact on profitability? I mean, whether in absorption costing high or variable costing is high. Change in inventory is positive. Just evaluate. And you will get this kind of question in examination. So give a thought over it. Any guess? Any means whatever may be in your mind, you can just give some clue.
Absorption costing?
Yeah, in absorption costing, the profit is high. Correct. Okay. So see what happened if the change in WIP is high, that means I increase my production. Okay. If I increase my production, okay. So what does it mean? Some cost of production overhead I capitalize. Okay, if I capitalize in as per absorption costing. Okay, and because of that reason, the profit in absorption costing is high. Okay, and if it is negative, what does it mean? My production is less than the sale. So whatever the cost I capitalize in a previous year, that get debited in a current year as per the absorption costing. Okay, and because of that reason, my profit as per the absorption costing is less. Okay, see, we go one by one. Okay, in absorption costing, we just evaluate the absorption costing. Okay, my WIP or FG increase. Okay, so whatever may be the opening stock, fixed production overhead, that charge in current year. Okay, but closing stock, fixed production overhead get postponed. And as there is increase in stock, okay, increase in stock, so that's why less amount debited and more amount postponed.
So can you explain with some example?
Okay, we'll do. Okay. Okay, if I consider the opening WIP of 5,000, okay, and the closing WIP is 7,000. Okay, so this is, and this WIP, if you see, considered 3,000 variable cost plus 2,000 fixed cost. Okay, and in 7,000 also, variable cost is 4,200, like 60%, and the remaining 2,800 is my fixed production overhead. Clear? Okay. So now what happened, if I prepare, means I'll prepare the variable costing first, means the contribution costing method. Okay. So like 5,000, for 5,000, for 7,000, current year I produce a say for the 20,000. And for that, my variable cost is, if I consider 12,000, and 8,000 is my fixed cost. Okay. Now, as per contribution margin, contribution costing, my sale is 30,000. Variable cost is 12,000. Okay. So 18,000. And then the fixed cost is 8,000. So profit is 10,000. Profit. I assume there is no SGA because it will not impact, because it is the same in both situation. Okay. So it is like this. All is only production overhead. Okay. Now in absorption costing, how we need to do the adjustment? My sale is 30,000. Okay. Variable cost, I will not take it. I need to consider the cost of goods sold. Clear? So if I consider like the 5,000 is my opening WIP, 7,000 is my closing WIP. Okay, here I'm just take a formula. Okay, and the current year total cost is variable plus fixed is basically the variable, and it is basically the 20,000. So what? How I calculate the cost of goods sold? Opening stock 5,000 plus 20,000 is my, okay, and the 7,000 is my closing stock. So total debit amount is 18,000. Okay, so minus 18,000 is my cost of goods sold. So my profit is 12,000 against 10,000 of the profit as per contribution costing. Are you able to clear on this?
So, sir, the fixed cost which remains in the business, that won't be affected from this absorption costing?
No. That is basically the affected to the absorption costing. Fixed cost capitalized over the inventory. Because of that reason, the profit get fluctuated with respect to contribution method. In contribution method, what we do, we calculate entire fixed cost as a period cost. Okay, but in absorption costing, we transfer it first to the inventory, means entire fixed cost we capitalize. Only those amount we debit in a current year which we sell. Actually, only those amount we are debited which we capitalize on an inventory which we sell. So if the situation is reverse, say for the opening is 7 and the closing is 5, okay, so in that situation 27 minus 5, this is your 22,000, here it is 22,000 and 8,000. Why this happened? Because in a current year, my like fixed cost in a absorption costing is debit to P&L, more P&L because of change in inventory. Like certain portion of the opening that also get debit in a current year, and whatever the I incurred in a current year, that also debit in a current year. If I my inventory, like if I consider, if we go in a quantitative form, okay, my inventory valuation is from 7,000 to 5,000. Okay, so that what does it mean? Opening inventory also I consume in a current year. Okay, but if it is in reverse way, 5,000 to 7,000, So whatever may be the opening inventory, that is as it is, but there is an additional inventory I generated in a current year. So whatever may be the portion of the fixed production overhead debit to the inventory, which is not I sold it, which is again in my balance sheet. Okay, so related to that inventory, the production cost get carry forward for a next year. So that's why in the current year, the less amount of cost get debit to the P&L.
So for in absorption costing, won't that be unfair because major fixed costs have been capitalized, but in a actual scenario, we should not capitalize the cost. Every year's cost we have to reduce it in that same particular period itself.
Correct.
Won't
But
that absorption costing is less effective?
no, see, it depends. Okay, I tell you, because see, again, as per US GAAP, you need to follow the absorption costing. Okay, why you need to follow the absorption costing? Because whatever may be the expenses you are incurring for producing the goods, that is the entire cost, whether it is variable or fixed cost associated with that goods. It is not the period cost. Okay, like the depreciation on a machine or the factory building. It is not the period cost. It is the cost we incurred to produce the goods. So you need to recognize this as a cost only when you sell the goods. Matching concept principle. Okay, if you're not able to sell the goods, then it is act as your asset, still act as your asset. Okay, and you need to capitalize in inventory. Means I'm not saying just because it is given in a US GAAP, so that's why you need to follow. But just keep in mind the logic. Okay, see, whatever the cost we incurred, whether it is a fixed in nature or the variable in nature, which is related to the production of goods. Without that, you cannot produce the goods. Without machine, you cannot produce the goods. So depreciation charge on a machine is the cost we incurred to produce the goods. So unless and until you are not selling the goods, you cannot recognize the revenue. So if you cannot recognize the revenue, then how you can recognize the cost as an expenses which you incurred for manufacturing those goods? Here we are talking about only fixed production overhead, not selling and admin expenses. Selling and admin expenses in both scenario is a period cost. Only difference is production overhead. Clear?
Yes, sir.
Okay. So, I mean, Sardik, if you have doubt, we can discuss again. That's not an issue. Okay. But again, I'm telling to everyone, this kind of question you will get in an examination. So just be clear with the logic. Okay. And the simple formula is if there is increase in WIP, then profit in absorption costing is high. If there is a decrease in WIP or FG, then profit in absorption costing is less. Yes, Hardik.
So, sir, in real a production house in the real world, the absorption costing is used for the particular products.
No, it is not like this. I tell you, means because I am also belong from the manufacturing unit. Okay, so for management reporting purpose, I use the contribution approach. Okay, but for the financial purpose, or how I can say, for the balance sheet preparation or for statutory purpose, I need to use the absorption costing. Because see, from management prescriptive, you cannot control the fixed cost. So that's why you need to always evaluate on a contribution basis. Okay, I never consider the absorption costing in a management reporting. Management reporting, I consider only the contribution margin approach, contribution costing approach. Okay, but for financials, for the government authorities, we use the absorption costing. Okay.
Okay, sir.
Yeah. So we will take a 15-minute break here and then again I start. Okay. So, means that we already saw revenue less cost of goods sold, gross margin, operating expenses, net income. That is as per absorption approach. Then in contribution approach, revenue minus variable cost, contribution margin, and less fixed cost, which will give a net income. Okay. So, variable cost include direct labor, direct material, variable manufacturing overhead, shipping and packaging, and variable selling expenses. So all variable cost you need to consider while calculating the contribution margin as per contribution approach. Okay. The total or per unit. So revenue, variable cost and contribution margin may be expressed in total on a per unit basis. Unit contribution margin, this is also the unit sell price minus the unit variable cost, and the contribution margin ratio. Contribution margin ratio is the contribution margin expressed as a percentage of the revenue. So it is basically margin ratio, basically the sales minus variable cost divided by sales. This we need to depict in terms of percentage. Absorption approach versus contribution approach. So here you can see in absorption approach, under the absorption approach, all fixed factory overhead is treated as a product cost and is included in inventory value. So cost of goods sold include both fixed cost and variable cost that you need to consider. And in contribution approach, under the contribution approach, variable costing, all fixed factory overhead is treated as a period cost and is expressed in the period expense in the period incurred. So inventory value include only variable manufacturing cost. So cost of goods sold include only variable manufacturing cost. Okay. So see again, in contribution margin, all the fixed costs we need to consider as a period cost. So that's why if there is an increase in work in progress, okay, so there is no deferment of the fixed cost in a contribution margin approach. So that's why the profit is less in a contribution approach. Okay. But if the WIP get reduced, so whatever may be the postponed cost from a prior period, that get debited in a current year. Okay. So because of that reason, in an absorption costing, the profit is less as compared to the contribution approach. The treatment of selling, general and administrative expenses, this is more or less same. Absorption approach, under the absorption approach, both variable and fixed selling, general and administrative expenses are part of operating expenses and are reported in the income statement separately from cost of goods sold. And in contribution approach, under the contribution approach, the variable selling, general and administration expenses are part of total variable cost for the contribution margin calculation. So product, here you can see the differences in a product cost as per absorption costing, direct material, direct labor, variable manufacturing overhead, fixed manufacturing overhead. And here product cost is direct material, direct labor and variable manufacturing overhead. If you see here, the variable selling expenses we are showing separately as a period cost. Okay. Period cost, variable and fixed selling, general and administrative expenses. Period cost, fixed manufacturing overhead and variable and fixed selling, general and administrative expenses. So that you need to keep in mind. Okay. Because this is also the okay. Sales common for both. Okay. Product cost. Variable raw material plus variable direct labor. Okay, here also variable raw material plus variable direct labor. Okay, plus fixed production overhead. Okay, this is missing here. Okay, if you see or plus variable overhead. Okay, fixed overhead is missing in a contribution margin. This will give the gross profit. Okay, and this will give the contribution margin. After that, you need to deduct all period costs. So here, variable plus fixed selling expenses, SGA, selling general and admin expenses. Okay, and here fixed production overhead as well as variable plus fixed SGA. Okay, so this way we are going to calculate operating profit. Operating profit, that you need to keep in mind. Okay, so that is important. Actually, you need to keep in mind. I mean, as per absorption costing, whatever the component arise, cost component, that we need to bifurcate like this. Then gross margin and contribution method. So in like in absorption costing, we calculate the gross margin, and in contribution costing, we calculate the contribution margin. So it is sell minus less cost of goods sold. This will be the gross margin. Then less variable selling and administrative expenses, fixed selling and administrative expenses, and operating income. The same. Sales less variable cost, cost of goods sold, exclude fixed overhead, less variable selling and administrative expenses, contribution margin, and less fixed expenses. But this variable selling and administrative expenses we consider as a period. So entire amount we need to keep it transfer here. And the less fixed expenses plus fixed and manufacturing overhead, final selling and fixed selling and administrative expenses, which will give the operating income. So gross profit margin may also be stated as a percentage, which is calculated as a gross margin or profit divided by the net sale. Okay. So effect on income, that means we already discussed, we just go through it. If all the production is sold every period, both method produce the same operating income figures. Okay. Because then entire fixed production overhead, okay, is charged to P&L. Okay, because there is no opening or closing WIP or FG. Okay, but if there is a change in WIP and or FG, so what would be the situation? Okay, so first scenario, if production is greater than sell, what is the effect on inventory? Whether the inventory is higher or inventory is less. If production is greater than sell, so it is leads to increase in inventory. Okay, because if the production is higher than sell, so my change in inventory is higher. Okay, or there is an increase in inventory. If there is an increase in inventory, if you observe in an absorption costing, okay, we charge the inventory direct material, direct labor, variable production overhead, okay, and fixed production overhead. Okay, and in variable costing or contribution costing, direct material, direct labor, and the variable production overhead. Okay, so inventory valuation in absorption costing is high as compared to the contribution costing. Okay, why? Because the fixed production overhead is missing in contribution costing. Okay, if the inventory is high, inventory valuation is high in absorption costing, what does it mean? More expenses capitalized, instead of expense out. Expense out in absorption costing. Okay, so more expenses capitalized instead of expense out. Okay, what does it, I mean, because of that in absorption costing. Okay, in absorption costing. Okay, and because of that, if there is an increase in inventory, okay, full cost not debit to P&L, it is P&L. Okay, not debit to P&L, and it is capitalized in inventory. Okay, and if the situation is reverse, okay, so what happened? Last year inventory cost is debit in a current year. Okay, and current year fixed production overhead cost less capitalized. Why it is less capitalized? Because sales is higher than production. If the sales is higher than production, that means a change in inventory is less or negative. Negative. So change in inventory is negative. That means whatever the manufacture in past year or earlier year, that we sell in a current year. And if we are selling in a current year, then whatever may be the cost accumulated on a last year inventory, that charged to P&L in current year. That is in absorption costing. Okay, so sales greater than means if we just read it, okay. So under absorption costing, a portion of the fixed manufacturing overhead is included with each unit in ending inventory. Under the variable direct costing, all fixed overhead is considered a period cost and is expensed during the period. Okay, so because increasing inventory, we cannot charge full expenses in an absorption costing. Okay, we are going to charge some expenses. We are charging some expenses to the inventory. So some production cost capitalized with the inventory. Sales is greater than the production. So under absorption costing, the fixed manufacturing overhead carried over from a previous period as a part of beginning inventory is charged to cost of the sale in a current year. Okay, and the less portion of the expenses we capitalize because there is a decrease in inventory. Okay, so under variable direct costing, those fixed costs were charged in income in a prior period when they were incurred. So examiners frequently ask about the difference between the variable costing net income and the absorption costing net income. Okay, so you need to follow the simple cell. Compute fixed cost per unit, fixed manufacturing overhead divided by unit produced. Compute the change in income, change in inventory unit multiplied by fixed cost per unit, and determine the impact of change in income. Okay, so just keep in mind, you will get 2-3 questions on this topic. So you should be very clear. If there is, I mean, just keep in mind 2 lines. If there is an increase in inventory, then the profit in absorption costing is high. If there is a decrease in inventory, then profit as per absorption costing is less. Keep it simple. So here, increase in inventory, absorption net income is high than variable net income, and decrease in inventory, absorption net income is less than variable net income. That you need to see. Now, benefit and limitation of each method. Although the absorption costing is required by GAAP, net income under the method is less reliable for performance evaluation purposes. So, as I already informed you, okay, in practical scenario, in a company for management reporting, we generally use the variable costing. We are not using the absorption costing because the fixed cost cannot be controlled by the operation head or the managers. Okay, so we cannot evaluate their performance on the basis of fixed production overhead. So we generally evaluate the performance of the management on the basis of variable overheads or the variable direct costing. Yeah, so that is the case. And then you can calculate. Okay, so total cost, absorption method, product cost, contribution method, product cost, it is same. Labor, direct and indirect, fixed building maintenance, and the yeah. So it is in a contribution margin. This is missing somewhere, and the overhead variable and fixed, and then variable we are giving here the fixed again missing here, and then the commission to salesman and freight. So this way we calculate 10.8. So this is basically the SGA, commission to salesman and the freight outward. So that's why we are not considered here. Okay, they just give up to the contribution margin or the gross profit level. This is the part of selling, admin and expenses, last two line. Okay, rest just keep in mind the fixed overhead is missing in the contribution margin. Missing in the contribution margin. Okay, and accordingly we evaluate the performance of the like the managers. Okay, now break even analysis. So break even analysis is basically BP. Okay, we have some fixed cost. Okay, how much sales we need to generate which cover my fixed cost. Okay, so sales we cannot take on sales value. Okay, because whenever we do some sales, say for 1000, first we need to absorb the variable cost. Okay, say for 600, so my contribution margin is 40. Okay, if my fixed cost is 5 lakh, okay, my per unit contribution margin is 40. Okay, okay, so how much unit I need to produce to cover my fixed cost? 12,500. Okay, you can see like sales 12,500 multiplied by 1000. Okay, variable cost 12,500 multiplied by 600. So what is my contribution margin? 12,50,000 minus 7,50,000, 75. So it is 50 lakh. Okay, I consider the 5 lakh 12,500. Okay, it is not the 40, it is 400. That's why this happened. So unit is 1250. So I'm just revising. Okay, so it is 5 lakh. So fixed cost is again 5 lakh. Okay, so here the net income is Means I am able to generate the contribution of margin of 400 unit, and I need to cover the fixed cost of 5 lakh. Okay, so how much quantity I need to sell? So it is 1250, so that I can cover my fixed cost. That is my break even analysis. Okay, so there are very, I mean, the contribution margin ratio. Sometimes you can use the dollar amount, you can use like this. Okay, so we go one by one. The following information applicable to green grass industries and will be used for all the example in the next several sections. Okay, so sell price per unit is $125. $125. Okay, and the variable cost 50. Okay, the contribution margin per unit is 75. So it is 75, and the contribution ratio is again that you can calculate. It is basically the 75 divided by 125. So it is 60% is my contribution margin ratio. Okay, so like contribution margin per unit divided by sales per unit. That is my contribution ratio. Okay, so fixed cost is 1,50,000. 1,50,000. So how much unit I need to sell to cover my fixed cost of 1,50,000? So when I sell one unit, even though I am getting a 125 as a sell price, but net saving is basically the 75. So if I'm selling one unit, so I can cover 75 rupees of fixed cost. Okay, I want to cover total fixed cost of 1,50,000. So what is my BEP in unit? 1,50,000 divided by 75. So it is 2000 quantity. Okay. So from BEP, I know the BEP in unit. So what would be the sales value at BEP level? Okay. So see what happened when we see the financial statement. Okay. So there is no much quantitative detail. So we need to know what is my like sales value. What is my sales value where I can achieve the BEP. Okay. So I know the BEP in unit. Okay. So in dollar, BEP in dollar. Okay. So can anyone tell how I can calculate the BEP in dollar here? Any guess? As you know, the BEP in unit is 2000 quantity. So just apply the sales value so that you can get the BEP in sales value. So this multiplied by 125. So that is basically 250,000 turnover. Okay. That is expected to cover the cost of 150,000. Okay. So this way you can calculate the BEP. Now what happened with this formula? Okay. If I want to earn the profit of 60,000 pre-tax, okay, okay, or 36,000, 40% is tax rate, so 36,000 post-tax. Okay, keep in mind, always you need to, while calculating the desired profit, always you need to consider the pre-tax profit, because tax anyhow you need to pay. Okay, so it is not the part of your contribution margin expenses. So that's why you need to always add the 60,000, not 360,000. If they gave the 36,000 only post-tax, okay, and the tax rate is 40%. So you need to first convert in a pre-tax. Okay, say for 36,000.6. So it is 60,000 that you need to convert, and then you need to add in a fixed cost. The formula is fixed cost plus desired margin divided by contribution margin per unit. then you know how much amount, how much unit you need to sell to get the desired profit of 60,000. Okay, so for that you need to add the pre-tax profit in a fixed cost. Means the same methodology. The only thing is that you are going to add the pre-tax profit here. This is my pre-tax. So it is 350,000. So when you sell the 350,000, okay, so like or 2,800 unit multiplied by 0.4 is your variable cost. So your contribution margin is 2,10,000, and then this is variable cost. This is contribution margin. This is fixed cost. Okay, so that is basically the 150,000. Okay, so here 210,000 minus 150,000 is basically your desired margin, pre-tax, and then the tax, if you apply the 40%, okay, which will you will get post-tax profit. Clear? Potential unit sell to 5,500 at the current sell price, and a maximum 3,000 units sell to reach the market situation. So to reach market saturation. So here you can calculate what would be the maximum profitability you can get it, and the estimated profitability at 2,500. Okay. So break-even point in a unit, total fixed cost divided by contribution margin per unit, which we already discussed. So the same as the example for calculate the green grass break-even point, 2,000 unit, which we already discussed. So company will need to sell 2,000 unit in order to recover the variable cost of $50 per unit and a total fixed cost of 150,000. In dollars, the same, whatever may be the break-even point in a dollar is equals to unit price multiplied by break-even point in quantity. Okay. Calculate the break-even point in dollar. Okay. So during this is 2,50,000, which we already discussed. So divide total fixed cost by the contribution margin ratio. Okay, that is basically the break-even point. Okay. See, instead of calculating the number, okay, quantity, I know my fixed cost is 1,50,000. Okay, and if I divide with the contribution margin ratio, which is 60%, then I can automatically get to 50,000. This is BEP in dollar. That also you can use. Okay, instead of contribution margin per unit, if you use the contribution margin ratio, okay, so that will give directly break-even point in a dollar. Okay, if you use in denominator contribution margin per unit, then you will get the BEP in number of unit. And if in denominator you are using contribution margin percentage, okay, or CM ratio, then you will get the BEP in dollar. Okay, or INR amount. Okay. Then calculate the break-even point in dollar using the contribution margin ratio. So it is 250,000. Okay, required sell volume for target of the profit. So you need to add pre-tax profit in a fixed cost, that you need to keep in mind. So it is fixed cost plus pre-tax profit, and then contribution margin per unit or the contribution margin ratio. So if you see 150,000 plus 60,000 divided by 75, which gives us the 280,000. Okay, and if you cross check, you will get the 60,000 pre-tax profit and then 40% tax, so 36,000 post-tax profit. desired profit. So again, variable cost plus fixed, okay, summation of total pre-tax profit. $3,50,000. So it is in amount, yeah. So contribution fixed cost plus pre-tax profit divided by contribution margin ratio. Okay, so if you use the ratio, then you will get directly the BEP in dollars. So 175 plus 60 divided by 60%, you will get directly 350,000. Otherwise, you can add variable cost plus fixed cost or the desired profit. Then predicting profit based on the volume means now you can predict the profit. So we can go again the question. Potential unit sell 2,500 at current sell and the maximum 3,000. Okay, so 2,500 and 3,000. Okay, and then okay, 125 it is given. Sell 125, variable cost 50, and the fixed cost 1,50,000. I'll just keep. Calculate the gross profit if the company sell 2,500 unit. Okay, so gross profit we can calculate 2,500 multiplied by 75. Okay, whatever may be the amount minus 1,50,000. Like this. Okay, so it is 2,500 which is 187,500. So it is 37,500. Okay, so this is basically the quantity, expected quantity sell. This is contribution margin per unit. Okay, we derived it sell minus variable cost. Okay, and this is my fixed cost. Okay, so this is basically the net income or the gross profit at 2,500 sell. Quantity sold. Okay, based on the assumed volume. So like sell price, again fixed cost, variable cost plus pre-tax profit divided by number of units sold. So that should be the sell price per unit. So that also we can calculate basically. So break even. Part 4, calculate the gross margin green grass per unit sell price needed to produce its desired pre-tax profit given the market situation level of 3,000 unit. Okay, so what happened here? We don't know the contribution margin. Okay, we just know the fixed cost. We just know the fixed cost, assume, and the variable cost. Okay, we don't know the sell price. So how we are going to calculate this? I know the 3,000 unit, which is equals to fixed cost plus desired pre-tax profit. Okay, divided by contribution margin per unit, or yeah, per unit, because we are I'm considering the 3,000 as a quantity. Okay, so it is contribution. If it is a sales value, okay, then we need to consider here the ratio. That also you need to keep in mind. Contribution margin ratio. Okay, so 3,000 unit equals to 1,50,000 plus 60,000 pre-tax. Okay, divide by contribution margin per unit. Okay, so contribution margin per unit equals to 2,10,000 divided by 3,000. Okay, so contribution margin is equals to 3,000 divided by, so it is basically the 70,000. No, not 70,000. 70 rupees contribution margin I need. Okay. So if I need the 70 rupees contribution margin per unit, what would be my sell price? Okay. Sell price equals to per unit equals to contribution margin per unit plus variable cost per unit. Okay. So as we know, contribution margin per unit equals to sell price per unit minus variable cost per unit. Okay. So what I did here, rearrange. Okay. So sell price, I take it this side and the variable cost, I take it this side. So it is basically the contribution margin per unit plus variable cost. So this is contribution margin. I need 70 and the 50 is my variable cost. So total value is 120. Yeah, 120 per unit. Okay. Are you able to understand this point? What I did here, I know the 3000 as a quantity, okay, where I need to earn the 60,000 profit and 1,50,000 fixed cost, okay. So I am not aware of this amount, okay, contribution margin per unit, okay. So what I did here, 150 plus 60,000, 150 plus 60 divide by 3000 and the cost per unit, I'm to calculate the cost per unit, okay. So which is basically I need the $70 as a cost per unit. So my sell price is contribution margin per unit plus variable cost. So 70 plus 50 is my sell price. So 120 I need to charge so that I can cover the desired margin of 60,000 at on selling 30,000 unit. Okay, so this is basically the break even, okay, and the desired margin. Okay, now what is my margin of safety? So actual sell minus BEP sale, that is my margin of safety. Okay, margin of safety means how safe I am. Okay, so that I can avoid the losses. Okay, so margin of safety sales in dollar equals to total sales in dollar minus break even point. So actual sale minus BEP, that is basically the margin of safety sale. If I need to calculate the in percentage, so it is margin of safety sale in percentage, margin of safety sale divided by total sale. Okay, now break even chart. So this way you are creating a break even chart. So if you see, yellow line is total cost, fixed cost, because it is a straight irrespective of the volume. Then total cost is basically which is originated from the originated from the fixed cost, and the variable cost is from zero. Okay, so BEP point is basically where the total BEP point is basically the quantity where the total cost intersect the sales value is also given. Thus, when the total cost intersect with the sales value, that is my BEP point. This is variable cost. This is fixed cost. Okay. So from here, total cost started. Okay. So it is basically this way, and then the sales value is also like this. Okay, so this will be my BEP. This is total cost. Okay, and this is my sales. So if you see, this area is basically the profit for me. Then target costing. In target costing, the basic concept is we know how much profit we need to arrive. Or profit need to take. Then market sell price. Okay. So as we know this two factor, okay, so I am able to get the cost. Sell minus profit. Okay. And then I put an effort so that my end product I can manufacture at this cost. Okay, so cost determination. The concept of target costing uses the selling price of the product to determine the production cost to be allowed. So target cost of the product is the market price minus profit calculated. So market price minus required. Okay, so as I said, sales and profit I am aware, means I cannot control over it. So what I can control? My cost. Okay, whatever the profit I required as it is. Sell price, it is driven by the market, so I cannot control the sell price. So what I can control? The cost. Okay, so what is my target cost? Sell minus the desired profit. So implication of that target costing. So in management, if management commit a target cost, serious measure must be employed to reduce the cost. So compromise the quality. Okay, if I want to manufacture the product in a given cost, okay, so then what is the way out? We need to manipulate the situation, okay, and we need to see how we can reduce the cost, and for that some factor we are ignoring. The first is basically the compromise quality, then increase marketing and downstream cost. So firm competing in this type of environment may incur increased downstream cost in an attempt to differentiate their product and create a brand loyalty and a competitive advantage. Then product design. So the product may have to redesign so that we can reduce the cost, a reduction of cost throughout the life cycle of a product. Okay, so maybe you can use the Kaizen method. Okay, so this is basically the target costing. I mean, the easy concept in target costing is basically you cannot control the sale price and you cannot compromise with the profitability. So whatever may be the difference, that you need to put the or manufacture the product within this cost only. So the way out is basically, the one is compromise quality. Second, basically you need to increase the marketing and downstream cost. Okay, so that you can create a brand loyalty. Okay, and the customers are ready to buy maybe the inferior quality product. Okay, and the product redesign. So like whatever the expenses we are incurring for the product, okay, that we need to evaluate how we can reduce it, and for that sometimes the redesign is required in a product. Then budgeting. Okay, so I mean, today when I start, I just inform that whenever we prepare a budget, okay, whenever we prepare the budget, we start with the cells. Okay, can anyone tell? I mean, in a budget process, what are the? I mean, the start point is cells. Okay, so just we need to recollect what other budget we are preparing or what other planning we are doing. Means you are doing a budget, then what is basically the outcome of the budget, and what are other steps? Why we are saying operational and tactical planning? Because we go with the theory, but first I want to explain the practical budget scenarios. Okay, from sales, first we do the production plan. Okay, so how we are doing a production plan? Can anyone guess how much we need to produce? Say for I budgeted that I want to sell 3,000 quantity. Okay, so on the basis of 3,000 quantity, how I can find out how much I need to produce? Okay, so we need to evaluate, means if I want to sell the 3,000 quantity, I need to check what is my opening stock. Okay, what is my desired closing stock? Okay, I know how much I need to sell. Okay, so what is my production? Clear? So say for the opening stock is 100 quantity. I want to maintain the 200 quantity as a closing stock. Okay, closing stock 3,000 quantity I am going to sell. Okay, so how much I need to produce? Can anyone tell? 1,000 is opening stock, 2,000 I want to carry forward. I want to sell 3,000. Can anyone tell how much I need to produce? How much? So 3,000 plus 200 minus 100. So it is 3,100 I need to produce. So that I have an opening stock of 1,000. 3,000 is my production. 3,100 is my production. 3,000 I need to sell. So remaining 2,000 is my closing stock. Okay. So now I have the number of production, which is 3,100. Okay. What is next? I want to produce the 3,100 quantity now. This is clear. What next planning you are going to do? Any guess? Okay. After that, you need to see the requirement. To produce 3,100 quantity, I need to see first direct cost. So what is my direct material and what is my direct labor? Okay. So of course, there is a fixed production overhead that also we need to plan. But first, because this affect your capacity. Okay. So what is the direct material requirement and what is my direct labor hour requirement? Okay. Now I want to plan what is my direct material cost. What I need to consider. Any guess? Okay. So if I want to plan the direct material cost, first I want to identify how much quantity I need to purchase. Okay. So how I am going to calculate? Again, what is my opening stock of raw material? Okay. Desired closing stock of raw material. RM. Okay. How much I need for a production? Okay. And then how much I need to purchase? Okay. Say for one quantity, you need a 4 kg of the raw material. Okay. And you have an opening stock of say for 500. Okay. Closing you need to maintain a 1000. Okay. How much quantity you need to transfer to the production? Can anyone guess my earlier with reference to the earlier example? This and this. One quantity require a 4 kg. And if you see here, you have how much we need to produce. On that basis, how much raw material you need to transfer to the production process. Any guess? So whenever you transfer to the production, this is not on the basis of sell. This is on the basis of the production. So you need to use this quantity because you want to, even though you need to sell the 3000 quantity, but you need to manufacture 3100. Okay. So 3100 multiplied by 4 is basically 12,400 quantity. Okay, so on that basis, 12,400 plus 1,000 minus 500 is basically the 12,900 quantity you need to purchase, kg you need to purchase. Okay, purchase. So if the raw material cost is $1 per kg, okay, so you need to buy the raw material worth 12,900 multiplied by 1, which is again $12,900. Okay, so this way you are going to calculate the purchase. Now, direct labor requirement. Okay, so you need to produce 3,100 quantity. Okay, so out of that, there is an opening WIP. Okay, opening WIP, which is already 40% completed. Okay, so and that may be the 1000 quantity. Not 1000, it is too high. 200 quantity. Okay, you are expecting there should be a closing WIP. Okay, which is again the 400 quantity and 30% completed. Okay, so how much direct labor you require, and the per quantity you may require the 2R. So instead of 3,100 full quantity production, how much you need to produce? In a weighted average, we already discussed this. So for total R requirement, means if you see the 400 is a pending, 3100 quantity I need to complete produce. Okay. So out of that 200 quantity already 40% process. Okay. So how much I need for the 200? Okay. Multiplied by 60%, multiplied by 2. Okay, because 60% requirement in a current year. Okay, and the 2900, this is I need to produce fully 100% multiplied by 2, and the 400 quantity multiplied by 30% multiplied by 2. This is my labor requirement. Okay, because 3100 I want to produce fully. Along with that, 400 is my partial production. Okay, so it is basically this way you need to calculate, and that is my direct labor hour requirement. Okay, so this way you need to calculate, means what is your, means you can budget what are the costs for the various factor, and then the fixed overhead, SGA, everything that you can cost, means okay, you can compare the past trend and then you evaluate whether any additional adjustment required, because these are the fixed expenses. So more or less same expenses with respect to prior year get carry forward, or there is a increase in 10%, whatever may be the inflation or the price revision you are going to consider or assuming. Okay, so this way you need to calculate. Main, you need to calculate the purchase quantity, direct material, and the labor quantity, direct labor. Okay, so that basically the budget scenario, and then if the capacity get increases, okay, so you need to make a capex plan. Then the debtors creditors plan, means what would be the, so that you can prepare the proper cash flow. Okay, so we first means at operational level, along with this there is a like SGA plan and the fixed overhead plan. So fixed overhead is basically what is the salary of the supervisors salary. So how much increment we are giving, insurance expenses, okay, security expenses. Okay, so this is basically the fixed amount, and then how much increment we need to give. This way we need to plan. And the same is with the SGA, admin salary. Okay, other maybe the advertising expenses. So if like I'm not able to achieve the sufficient sale, or my profit margin target is very high, so then I can evaluate whether I need to go for advertising or not. Okay, so that is basically my then budget policies. So to effectively budget, an organization should implement the formal budget policies that include the management participation, budget guidelines. Budget guidelines is basically whatever the assumptions we are considering. Okay, so like how much profit we need to earn, that like decision or that guideline we are getting from the management. Okay, so and in all the budget process there should be a involvement of the management, so there should be a reciprocal commitment. Okay, and if there is any dispute arises, okay, so that can be resolved. Okay, say for like the production team may say I cannot produce that much, but the sales team have an order. Okay, so that conflict may get resolved. That's why the management participation is required. Budget guideline. Top management should provide guidelines for budget preparation based on the entity's strategic goal and the long-term plan. So this guideline should include evaluating current control, result to date, and the goal for the period, and management directive related to the budget. That these are basically the budget guideline. Then standard and benchmarking. So budget frequently revolve around the development of the standard, and standard have been referred to as per the unit budget and are integral to the development of the flexible budget. Okay. Like say for I prepare the budget for 10,000 quantity. Okay. But like after 2 months or 3 months, okay, it I come to know that because of recession in the market, market, I cannot sell the 10,000 quantity and it is cut down to 7,000 quantity. Okay, so then I need to prepare, means whatever may be the standard assumption, that I need to carry forward. But the same thing we need to prepare the standard quantity. Okay, so while preparing the standard, revised quantity, while preparing the budget for the revised quantity, what do you think? Which factor may get changed? Like I prepare the budget for the 10,000 quantity sale, variable cost, fixed cost, and the profitability. But now I want to prepare for the 7,000 quantity. So what factor get changed?
Variable cost.
Variable cost, sales get changed, variable cost get changed, and the profit get changed. Okay, so that is basically the flexible budget, I can say. Okay, so in a flexible budget, whenever we like cross check the performance evaluation, what we do, we carry forward the assumptions considered while doing a standard budget, but we apply to the actual or the expected quantity or the actual expected quantity, like this. Okay, then ideal and currently attainable standards. So standards are often set below the expectation to motivate the productivity and efficiency, but those standard costs must be revised periodically, generally once a year, to reflect changes in a previously determined standard. Okay, so what happened? There is a production overhead recovery rate. Standard recovery rate, okay, which is basically the $2 per unit. Okay, can the same rate I need to consider for next year?
No.
Sorry?
No, sir.
Yes. Why? Cost may increase. Okay, so we need to increase the rate. Increase the rate. Okay, cost may increase, so we need to increase the rate. Okay, but parallelly, if the efficiency increases, okay, that means the recovery rate should be go down. Okay, so that is basically the evaluation criteria. Okay, so this way, whenever you are preparing any ideal standard, okay, you need to make sure it is applicable in a current scenario. As the scenario changes or the period to period basis, okay, as you are seeing, okay, your rate may go down. Okay, there should be an over absorption. Okay, so if this is the situation, that means you are going in a correct way. That is my in this way you need to keep on evaluating. Okay, generally in most of the organization we are maintaining the standard cost just to evaluate the work in progress or just to evaluate, just to do the inventory costing. We are not using this kind of approaches for controlling the cost or give a better insight to the management. Okay, so that we need to do. Okay, so ideal and currently attainable standard. Okay, so ideal standard is basically means in practical scenario means what I feel basically where there is no inefficiency, okay, or everything is perfect, which is just too impossible. So there is you always need to make a provision for certain inefficiencies. Okay, there may be a certain spoilages, there may be a certain downtime. Okay, but you should aware means to what extent we need to make a provision. Okay, so ideal is basically what is the perfect situation, and the currently unattainable standard means in the given means the kind of manpower I have, the quality of the raw material I am using, what could be the average spoilage or the downtime that I need to evaluate. So advantage, An advantage of using the ideal standard is the implied emphasis on a continuous quality improvement to meet the ideal, and the disadvantage is the demotivation of the employees by the use of unattainable standard. Means if I assume in ideal scenario, in ideal situation, I'm able to produce the 3000 quantity. Okay. But in, as I said, there is a 10% I consider as for the inefficiency, and I am able to produce only 2700. So it is not the demotivating factor. Okay. But if it look like that you are inefficient. So I should have ideal base. Okay. So that I know what I can achieve, and I should have a currently attainable standard. Okay, so that I come to know, first evaluation is with respect to this, and the second evaluation is with respect to this, so that I can control as well as I can improve myself. Okay, if I'm not keeping the ideal, so what would be the situation? Okay, this will give me the satisfaction, and maybe I can go beyond that. Okay, so that's why always evaluate the ideal standard and the currently attainable standard. So advantages of the currently attainable standard fosters the perception that the standard are reasonable, and disadvantage required use of judgment and the potential manipulation. Okay, so if I give the unattainable, okay, that you need to achieve minimum, or that is expected reasonably. Okay, so it may possible that we are going to manipulate the numbers. I mean, sometime what happened, even though your production is not complete, but you dispatch it to the customer. Okay, and every adjustment is associated with the cost, because if you partially manufactured and dispatched to the customer, then installation or the commissioning or the post processing or the quality issue may arise at the customer end, which is again backfire to you. Means this will you need to give them correct product, or you need to rework on that product. Okay, and the cost get increased. Okay, so that is basically the disadvantage. Authoritative and the participative standard. So authoritative means, as name suggests, authoritative standard means on the management floating the standard, and there is no one can, executives cannot challenge it. Okay, they need to accept as it is. And the participative standard is just like a bottom up approach. Okay, it is not the top down approach. It is basically, all the managers who are responsible for the particular product are get involved and then mutually decide with the management. That is basically the participative standard. Okay, so advantage of the authoritative standard can be implemented quickly and will likely include all cost, and disadvantage, workers might not accept imposed standard. Okay, so that is basically the advantage and disadvantage. Means as there is no discussion required, so it is once the management is created, it is floated as it is. Okay, so it can be easy to it can quickly implemented. And in a participative, workers are more likely to accept the participative standard. Participative standard are slower to implement because there is a lots of discussion going on, the conflict resolvement and everything. But sometimes it is good because in future, if any like conflict arises or any issue arises, so as compared to that, it is better to have a proper clarity at the time of float of the standard. Okay, so but again, it is a slower to implement. Okay, so master budget we will take in a next class. Any doubt till now? Okay. So one question from my side. Any one of you started a practice to solving MCQs on a Becker? Means whatever the portion we completed till now?
Sir, we haven't received our materials yet.
Okay, so Shrikant, maybe you have the Baker material, Baker access. Have you started to solve it? Other than Hardik?
No, sir. Majority of us have not received the
Okay,
materials.
understood,
So we
understood.
are not able to
Solve the
go
question.
through the topics as well that much.
Okay, understood, understood, understood. Okay, so yeah, no problem. Okay. Anything, any point need to discuss?
Yes, sir. The numericals, like how it will be shown up in the exams, sir.
Okay,
Like what is the weightage of the numericals?
numericals basically all around 30% you will get in a bar, okay, and the 40%, 60% they check on a concept only. But numerical is also you are getting is a very slow, means it is not like the, I mean, the examples which gave here, that is also basically the lengthy examples, okay. So whenever, because this is basically the costing portion. So whenever we do the practice of this like module, at that time you come to know, but you will get the very less numerical.
So, sir, if you have any numerical based questions and all, can you just share in the group, please?
Yeah, yeah, I'll send it to you, no problem.
Okay, sir.
Yeah. Anything else? Okay. So if no query from anybody's side, then I'll close the class. Okay. So bye everyone.
Thank you, sir.